Now let's just mirror this over here on our Excel worksheet just to get an idea of this. Now we entered a sales receipt, but let's do it here. We're going to enter an invoice and then a receive payment, which will get us to the same point. We made a sale and they've already paid us for it. So if we entered an invoice, we'd have accounts receivable rather than it going directly into the checking account. So we'll go into accounts receivable. It went up by 108. Income going up with a credit. That's what the negative number represents here, a credit. And then we're going to say that sales tax payable, the liability, went up with a credit. So I know I'm using debits and credits. That's the easiest way to do it this way. So bear with me. We're going to then say that the cost of goods sold is going to be for the $70 for the sale of the inventory, and then inventory is going to go down with a credit of $70. So the net impact on net income, which is this bottom part of the trial balance, is $30. 100 minus 70. And then they will pay us. So let's say they actually pay us, which is going to be the second side of the transaction. So they paid us before they said, hey, I don't like this, and they're going to try to return it, right? So now we're going to say, all right, now I'm going to pay us. That means that the cash is going to go up of 108, and accounts receivable is now down. So notice after accounts receivable is down, I can't really issue them a credit memo. Or if I do issue them a credit memo, it's going to result in a negative accounts receivable, which might be something I would like to do if I'm saying I'm not going to give you money back, but I will allow you to buy another ticket to the movie in our example, in the future. So we're in the same point as a sales receipt or an invoice after we've already received the payment. Let's say we want to give them a refund then. What we need to do then is exactly reverse basically what happened here. So if I look at it from an invoice, the accounts receivable has already been cashed. So I can look at this transaction and then basically reverse it. That's what the refund receipt will do. So now we're going to say cash is going to go down, and then we're going to say that the income is going to be go down. Now the income is the problem because maybe I don't want to put it into income, similar to what we saw with the credit memo. Maybe I want to put it into sales returns and allowances. And then the sales tax is going to be reversed, and then the cost of goods sold is going to be reversed. If they return the inventory and we think the inventory is still good, that means inventory is going to go back up, and we have to reverse the cost of goods sold. If the inventory is no good, then we're not going to do this second bit because we're not going to get any inventory. We're just going to refund them because they broke it or it was defective or something like that. So let's see what would happen. We're going to say, all right, cash is going to go down instead of accounts receivable going up, and then income is going to be reversed. Now this one, I closed out these transactions here, I think is what happened. So let's say like we're in the next year. This is going to be the negative sum of this is the idea. And then this top bit is just going to be the ending numbers here. To do it from here, let's redo this down to here. Boom, boom. All right, that makes sense. Okay. Except that this shouldn't be negative. This should just be the sum. Why is that negative? What are you doing? All right, now we're in balance. Okay. So now we're going to say, all right, so then we're going to reverse that, and then income down here is going to be a negative income because that's a debit. And then the sales tax is going to be reversed. And then we're going to have the cost of goods sold, which is going to be going the wrong way. So we have basically a net, decrease. And then we've got the inventory is going back on the books. Inventory goes back on the books for the $70. I think that's right. And then the one problem here is the net income, because normally I don't like net income going down. This is going the opposite way. It's debited and it's usually credited. Usually income only goes one way. That's why we might change this to sales returns and allowances.